Has a new bull market begun? The answer is, we think, no. Market had one of the biggest weeks it's had in a long time last week. Strong up week, which, by the way, we were wrong. We thought it would go down and continue down quickly, or it would have a sharp rally, which it did. We thought the probabilities, however, would be the sharp decline rather than the sharp rally. And ultimately, the reality is that this rally is probably a bear market rally. It's probably going to continue somewhat longer, probably close to the end of November at least, and possibly all the way to early January. But whatever it is most likely a short covering rally. It is most likely a year-end rally, and that after it ends, the market should continue lower, at least for the first 4 months or 5 months of 2024. Okay. Now, we talked about the eclipse last week, which seems to have been correct in the sense that it required a very big move, and we got one. And we also note, looking at the examples that we've got, the 1948 market, which was one of the best matches compared to the present market, actually had the same position of Mars that we have this time. And because of that, it has a very significant rally before the break. And the break will still happen. If it repeats properly, if it repeats exactly, the break would start around December 1st and end around December 15th. However, there's another possibility, which is the 24-year cycle we've talked about, which had a low in October, which has been very, very similar all year since last October. It's been repeating. And it goes up into early January, but then that one breaks down, as you can see in this chart. We have for the longest time been expecting lower prices than the 41.25 support, which did get reached. And we do expect the 38.50 to 39.50 area will happen. And it's either going to happen after a rally that continues much higher in the next few weeks, or it will wait until the end of the year and happen January, February of next year. Either way, this is a short-lived phenomena. It may be dramatic. It may be sufficiently bullish so that it drives all the bears out of the market, but nevertheless, it is not the beginning of a new bull. Okay. Now, interestingly enough, we discussed in our clinic last week, which is an aspect of our forecasting class, that people should get a straddle position. And many of the students did so, and they made a lot of money even though we were wrong about the forecast. So trading is different than forecasting. Forecasting is telling you what is probably going to happen, but trading is based upon getting some level of verification, some confirmation that the thing has happened. If we waited last week for the market to go down even one tick before going short, there would have been no problem. We would have lost no money, and as soon as it rallied a day or two, we would have gone long. Very important that you also understand, we had a buy signal on one of our systems, we call it the momentum balance technique, that came in early on Monday, and we had a second one that came in on Tuesday. So there were actual empirical reasons to think the market would go up, and I'm not doing videos every day, which is not part of our protocol, but it's necessary if you want to really get this stuff down, you have to learn more. It's necessary to learn some of the techniques that will allow you to trade correctly along with the forecasting. And the next course will be starting on November 19th, on Sunday, November 19th. So the next thing I wanted to point out is that we have already seen that there's a projected target based on one of our techniques that indicates 44.50 would have been the first resistance level to reach before the market likely stops. It possibly will break through the 44.50 level and go higher, possibly all the way to 4,600 again. But in the meanwhile, there's probably resistance coming quite soon. There was a probability of short-term cycles will turn down in the next few days, having a low on the 8th of November, we've been saying for weeks, possibly a little bounce until the 13th or 14th of November, followed by another decline into the 16th or 17th. So there could be some hesitation on the way up, and then a rally from the 17th till at least the 24th, probably as late as the 1st of December, before a final high of this particular explosive move. At the same time, we wanted to point out a fascinating situation The pattern at the beginning of the Ukraine war with Russia, February 24th of 2022, lines up extremely well 20 months later with the low October 27th of 2023. And that the pattern going into that and the pattern after that seems similar to the other examples that we've been looking forward about the future. And it indicates we'd have a hesitation point in the next few days. The market stops going up, goes down, and ultimately has a low around the 16th or 17th. Then it rallies strongly until the end of November, early December, before going down fairly significantly after that. That matches the 1948 pattern, which, by the way, we still think the preference is the high will come in at the end of November rather than the end of December, early January. But if it does not happen if we do not get a large break in the first half of December and just a minor one, could go up higher in early January, and then January, February would be very severe decline into that 3850 area that we've been waiting for, and it would happen ending early March. There's also a low late April, early May after another rally. But that will be in our yearly forecast. We'll talk about that next time. Notice I've mentioned several cycles in describing what the market's doing. The reason is there are numerous cycles out there. And part of the skill in doing this is to locate which cycles are running right now. But because we only have a limited amount of data, even 100 years of data is not sufficient to find every possible combination of cycles that are working. And so you will at times always have a certain level of uncertainty. You can get the risk to be very limited. You can get the probabilities of being correct to be very, very high. But to get absolute certainty is impossible unless you had several thousand years of data to get every possible combination of cycles, every possible combination of the phasing of some of the larger cycles. And that's why you need to have stops in your positions. I also recommend that it's necessary to hedge your trades, particularly in a volatile market, which we're starting to have. It's very helpful because you can get very inexpensive options that expire the next day or the next week to hedge against futures or options that expire in the long term. And you have a tremendous ability with a small amount of insurance to protect your money and oftentimes even make money. Last week, because we had the hedge on, we actually made profit, even though we were thinking short. So it's necessary to know how to manage option pricing and how to handle option spreads in order to fully take advantage of risk control and risk management. All right, risk is the game. If you can not lose a lot of money when you lose, the market will help you make a lot of money when you win.